Welcome back. Mortgage applications on the rise last week, breathing some hope into the spring housing season. Diana Olick has the latest numbers. It's been, I would have to say, Diana, a little busier than feared.
Yeah, I mean, Kelly, the CPI didn't really help mortgage rates today as much as we might have thought when it was first released this morning. So bond yields plunged, but then they bounced back and then some more. So the average rate on the 30-year fix, which Mortgage News Daily ran about an hour ago, was 6.42%, down about 10 basis points from yesterday, but still higher than last week when investors had rushed into bonds after two employment reports suggested the economy was weakening faster than expected. So with lower rates last week, mortgage applications to buy a home rose 8% compared with the previous week, that according to the Mortgage Bankers Association. They were still, however, 31% lower than the same week a year ago when interest rates were lower. Now, buyers have been up against not only higher rates and higher home prices, but still very limited supply of homes for sale. Applications to refinance a home loan basically flat week to week and 57% lower than the same week a year ago. At today's interest rates, there are just very few borrowers who can benefit from a refi. For those looking to tap their home equity, they're largely opting for second loans rather than cash out refinances. And one final note, rates are now not that much higher than they were at this time last year. You know, last summer we were saying they were twice what they were the year before. Now they're only about 1 percentage point higher. Kelly?
Well, and you know my obsession with this spread between the 10-year and the mortgage rate, because it does seem like the banking turmoil has kept it a little bit higher than historically average.
Yeah, I mean, it's much wider than historically average, and part of that has to do with quantitative tightening, that is, the Fed not buying mortgage-backed bonds. They're also doing that with treasuries as well, but it's having a much bigger impact because they were a bigger share of mortgage market demand. Then you also have on top of that SVB and the concern over that and some selling of MBS, which doesn't actually go to the buyers who determine the mortgage rates, but when you have something going on in the market like that, it tends to widen the spreads, if that makes sense.
Exactly. No, and it's again, for buyers, there'd be even more relief and more activity if they came down to normal levels. Diana, thanks. Our Diana Olick.